Hi folks, Doc White here. Going to give you the very quick version of retirement planning here today. With retirement planning, the process is relatively simple and we've seen it before. First thing, determine your goals. Figure out when you want to retire, what you want to do when you're retired, and what's that lifestyle going to cost you. Next thing you need to figure out is what income are you going to have during retirement. Third step, determine how much you need to invest. And this just is an application of the time value of money principles. And the last step is determining where to invest, which type of plans. The first step is to come up with your retirement living needs. So put a budget together for what you think your expenses will be when you're retired. Do it in today's values. If you'd be comfortable in $50,000 per year in today's terms, then use that for your retirement living needs. Your sources of income. We have 5 or 6 main sources. Social Security is the first one that's usually listed, but don't plan on getting anything from them. Corporate retirement plans, such as pensions, well, they're going by the wayside. They're too expensive. But you will see 401ks, 403b, and 457 plans. If you're operating a small business, there are plans available for them as well. You have your personal retirement plans. These are your Roth IRAs and traditional IRAs. IRA stands for Individual Retirement Account. You can continue to work during retirement, or we can generate income from other sources, such as rental properties, other investments that we have, or we can start selling off some of our property or some of our assets. Please remember that Social Security is not a full retirement plan. It's a supplement to what you have saved up yourself. By design, Social Security is only intended to provide about 40% of your normal salary. For most of you folks, full retirement age is probably going to be 67 years. It may be bumped up to 70. I would not be surprised to see that. Well, how much do you need to invest to reach your retirement goals? This is where we apply the time value of money principles that we talked about in Module 3. And I'm going to show you the worksheet that I showed you in class earlier on. Here, you list in how many years, or you type in how many years until you retire. So for most of you, maybe 45 years until retirement. How many years do you plan on being retired? So from retirement until you die, your lifespan here, 35 years. Let's go with the pre-retirement inflation rate in today's terms. 3% is a good long-term planning number for that. Your pre-retirement nominal rate of return, that's what your investments plan to earn on average over the entire investment. And then what are those going to be during retirement? So the first step on here, line 1, put down the lifestyle that you want to have and what it's going to cost you. This is before any taxes are taken out. So if I want to have $50,000 before taxes, I'd be comfortable with that in retirement in today's terms. Then I'm just going to use $50,000. Second, put your expected annual Social Security benefits, and I'm going to say use 0. Third, your expected annual pension income. Most of you probably will not have a pension income, so let's just go with 0. And then income from other sources. This would be if you own rental properties or you have income coming from some other businesses or other sources. If you take line 1 and then subtract line 2, 3, and 4, this tells us how much you need to come up with out of your personal retirement savings to reach your goals. Let's inflate this using that 3% inflation rate. This says that $50,000 per year that we want to have for our lifestyle is actually going to cost us $190,000 the day we retire. In order to have enough money to pull that out every year during retirement, we need to have just under $4 million in your retirement account. And remember, I said you folks would need $3 to $5 million. Well, there's where the number comes from. Next line says, what's the value of your current savings? So if you have, say, $10,000 in your retirement accounts already, or mom and dad or granny or grandpa have gifted you some money, well, that's going to grow to almost $320,000 over this time frame. If you are currently making contributions like I am, we'd put that number in here. Let's just use 0 for now to see the total amount we need to put in per year. So we need to come up with $3.4 million on our own. That means we need to invest $8,200 per year, or roughly $645 per month to reach our goal. Now you're saying that's a lot of money. Well, what if your employer matches your contribution? Well, that might cut that number in half. So the earlier you start, the lower this number is going to be. The more aggressively you invest, the lower that number will be. Let's say we invest at 10%. We put most of our money in stocks before we retire. Now that number has dropped from $645 down to $285, but realize there's a lot more risk that you're taking when you invest in 100% stocks. When it comes to corporate pensions, plan on not getting one. Most companies are not offering these anymore. They've switched over to 401k type plans. But there are two main types of pensions you might qualify for. A defined benefit is the one you hear people saying, oh, I need to work 3 more years before I can retire. Your annual benefit is based on your years of service times your average ending salary times some factor, which is normally around 1.5%. That helps you figure out what your annual retirement benefit will be. Most cases, that is not adjusted for inflation, but some may have what's called a COLA, which is a cost of living adjustment. And again, these are very expensive for businesses, so you don't see these much anymore. The more common corporate pension you'll see is called a defined contribution, and this is where the employer just makes a contribution to your retirement account every pay period. They use some percentage of your salary or some dollar amount. Once the money is in the account, you have to do all the investing. They will not do that for you. With a defined benefit plan, the company does all of the investing. When you hear the term vesting or vested, vesting is just how long you need to work with a company in order to qualify for 100% of the retirement benefits. The main vesting period you're going to hear is immediate. Immediate means the first day that you start working there, you qualify for 100% of what's in your retirement account when you retire or when you leave that company. With 3-year cliff vesting, if you work for just under 3 years and you quit that job or you leave that company, you will get 0 of the retirement benefit that they invested for you. If you work for 3 years and 1 day, now you're 100% vested. If you were to leave that company, 100% of the money in the account would go with you. 5-year cliff vesting is very similar. Then there's graduated vesting. There's several different types of these. The most common ones are 2 to 6 years or 3 to 7 years. But just to keep life simple, let's use a 5-year vesting period. And the way your plan is set up is after you've worked there for 1 year, you are 20% vested in the account, which means if you were to leave that company, you would walk away with 20% of the employer's contributions and earnings that are in the retirement account. If you work there for 2 years, now you get another 20% for a total of 40%. Then it's 60%, 80%. And then finally, after you've worked there for 5 years, if you leave that company or when you retire, you are eligible to get 100% of your retirement benefits. This is going to vary from company to company, but those are the main types you're going to see. Now then, let's talk about those 401k type plans. Most companies have gone away from the pension plans because they're too expensive. But with the 401k plans, there's several different types. They all act about the same. There are some differences, but we'll just lump them in the same here. There's 401ks are for employees of for-profit companies. 403bs are for employees of nonprofits and educational systems. And 457 plans are for employees of state and local government. And then your federal employees and your military, a lot of times they have what's called a thrift savings plan or a TSP. Each of these they have some differences, but we're going to treat them as the same. With a 401k that is pre-tax, you tell the employer, I want to have a certain dollar amount or a certain percentage of my salary taken out of my paycheck every pay period and put into a separate retirement account in your name. You can do up to $19,000 per year, and there's a catch-up provision for those of you over 50, like me. This money comes out of your paycheck before taxes, which means it reduces your taxable income, and it reduces the amount of income taxes you have to pay this year. As long as the money stays in the account, the earnings are not taxed. It's called that they grow tax deferred. So there's no taxes until the money's withdrawn from the account. And then when they're withdrawn from the account, they're taxed as ordinary income. Your employer may match your contributions up to a stated percentage. They might say, we'll match you dollar for dollar up to 5% of your salary. That says if you put 5% of your salary in, they will add an additional 5%. So that's a way to earn 100% return on your investment with absolutely zero risk. With the pre-tax 401k type plans, your take-home pay is going to drop, but not by the amount you have withheld. In my case, if I have $600 a month taken out of my account, That's going to reduce my taxable income, which saves me on taxes. The amount that's withheld from my paycheck drops. So my take-home pay doesn't drop by $600, it only drops by $400. So this is a way to invest more funds and save yourself on taxes. As far as how this money is invested, got to remember the HR, your human resources at your company, will not tell you how to invest your funds. They will give you a menu and say choose amongst these different mutual funds in most cases, and it's your responsibility to decide. If you do not make a decision, or if you just want to use their default mutual fund, it's probably going to be one of those asset allocation funds that Dr. Cowan and I talked about in the investment section. Many companies are now offering what's called a Roth or a post-tax 401k. I really like these for you young folks, or if you're in a low income bracket. The contributions you make each period are not going to impact your taxes, so there's no impact on your annual taxes. But when you withdraw the money during retirement, all of the money you pull out will be tax-free. With all of these funds, whether it's the Roth or the traditional 401k type plan, they're very portable. Common question I get is, what happens if I change jobs? What happens to that money? As long as you're fully vested, all of that money that's in the account is going to go with you. And you have three options. One, you can leave the money in the account with your old company. You just can't make any new contributions. It'll continue to earn, but you just can't add any more. Secondly, you can try and roll it into your new company's plan. Not all companies allow you to do this, but I kind of recommend doing this because it just consolidates your accounts. And third, if you want to have more control over that money, rather than rolling it into your new company's plan, we can roll it into what's called a rollover IRA. This is where it's going into an individual retirement account. Keep this separate from all other individual retirement accounts that you have. And with all these retirement accounts, 59 and a half is the magic age. If you pull the money out before age 59 and a half, you'll pay a 10% penalty on that withdrawal, and you'll pay income taxes on the amount that you withdraw. That does not apply to Roth IRAs. With the Roth IRA, you will only be taxed and penalized if you take out the earnings of the account, not what you initially put in. Once you've reached age 59 and a half, there's no penalty for withdrawals. You can pull out whatever you want. You have pretty much complete control over that with the 401k type plans. So with your pre-tax accounts, once you hit age 70 and a half, you are going to have to take what's called required minimum distributions. This means you have to slowly pull money out of the account. There's a formula for how much you need to pull out. This is basically so that the government can start getting tax revenues from that money. Okay, for IRAs, we talked about them throughout the semester. All U.S. taxpayers who have earned income are eligible to create an IRA. This is going to be in your own name. So if you're married, it's just in your name. It's not you and your spouse. Your spouse can have an IRA and you can have an IRA. These are long-term investments. Your money is basically locked up until age 59 and a half. If you pull it out before 59 and a half, like I just said, you'll be taxed and penalized at 10%. There are two main types: traditional, which is good for folks who are in a higher tax bracket now, and Roth, which is good for people who are in a lower tax bracket, which is most younger folks right now. With the traditional IRA, you must have earned income during the year in order to make the contribution, and you have to be under age 70 and a half. That may have changed with the new tax law, but we'll go with that. That was the former tax law. Maximum contribution you can make is 100% of your earned income, up to $6,000 per year. So if you only earn $3,000 this year, the maximum you can invest is $3,000. If you earn $10,000, the maximum you can invest would be $6,000. This contribution must go in as cash. You can't move stocks, bonds, and existing investments into your IRA. For the most part, you need to just write a check and deposit the cash. Once that cash is in there, then it can be invested in stocks, bonds, mutual funds, certificates of deposits, ETFs, and so on. Again, for you folks, right now, I would not recommend investing in CDs for retirement just because they match the rate of inflation, if that. So you're not going to make much of a return with CDs. The contributions to a traditional IRA are usually tax deductible as long as you're under the adjusted gross income limit, which reduces your income taxes this year. All of the money that's in the account, whatever it earns, depending on how you invested it, whatever it earns, Those earnings are tax deferred, so there's no taxes as long as the money stays in the account. When that money is withdrawn during retirement after age 59 and a half, it will just be taxed as ordinary income. So what you're doing, you're getting a tax break now, and you're going to be taxed in the future. You're taking the risk that the marginal tax brackets or the marginal tax rates will not increase over time. And again, with traditional IRAs, there is the 59.5% rule. If you pull the money out before age 59 and a half, they will be a 10% penalty on the amount of the withdrawal, and they will tax you on the amount you've withdrawn. After age 59 and a half, you can withdraw as much as you want. However, whatever you pull out will be taxed as ordinary income. You don't have to withdraw anything until age 70 and a half, and that's when you need to start making the required minimum distributions. All right, for the Roth IRA, that's the one that I recommend for you folks. Again, the same limits. You can put up to 100% of your income to a maximum of $6,000 per year, as long as you are under the AGI limit, which I think is around $122,000 to $135,000. If you earn more than $135,000 of adjusted gross income, you cannot make a Roth contribution that year. With the Roth IRA, the contributions are not tax deductible. This means that they do not reduce your taxable income, so they have zero impact on this year's income taxes. But the really great part about them is that when you pull that money out, as long as you've had that account open for at least 5 years, all of the earnings you've earned over time are tax-free. And folks, you just can't beat that. That tax-free growth is fantastic. With the Roth IRA, you can pull out your principal at any point, and there's no taxes or penalty because that money's already been taxed. So if you initially invested $5,000 in your Roth and it's currently worth $7,000, if you withdraw $5,000 of principal from your Roth, that will not be taxed. There will be no penalty. But if you take more than $5,000, the amount over $5,000 will be taxed and penalized. There's no upper age limit on Roth IRAs. With traditional IRAs, you can only make contributions up till 70 and a half. With Roth IRAs, there is no upper limit. There's no required distributions. That money can stay in the account as long as you want. So there's no required minimum distributions with a Roth IRA. So the main questions I get about IRAs are, can I contribute to a 401k and an IRA in the same year? The answer is yes, you can. As long as you have the cash, as long as you have earned income, you can make contributions to any type of retirement account. Can you have a traditional IRA and a Roth IRA? Yes. Can you make contributions to both in the same year? Yes. But the maximum of the contribution is $6,000 per year combined. So you could put $3,000 into the traditional and $3,000 into the Roth, or any combination, as long as it doesn't go over $6,000. Can you have a pension plan, a 401k, and IRAs? Yes, yes, and yes. So we can have all these accounts at the same time. Can you convert the money that's in your traditional IRA to a Roth IRA? The answer is yes, you can. But as you move that money from the traditional to the Roth, however much you pull out and move is going to be treated as income during the year, so you'll have to pay income taxes in the year that you make that conversion. And the other main thing with IRAs, you are responsible for making the investment decisions, so use that asset allocation, use that diversification that we talked about in the earlier modules. So here's my advice on retirement. A, start early. The earlier you start investing, the easier it is to reach your goal, simply because of the time value of money and the tax-deferred growth. Second thing, develop your retirement goals. Think about what you want to do during retirement. Try and estimate what that's going to cost. Use today's values and plug that into my spreadsheet, and that'll help you figure out how much you need to invest to reach your goals. Third, understand your options. Talk to your HR person and ask them questions until you fully understand what your options are. Fourth, use your funds wisely. First thing you should do, if your employer offers matching, you should put in the minimum amount to get the maximum match from your employer. Then if you still have some extra cash available, I'd suggest putting that money, the next money, going in either into a Roth IRA or a Roth 401k if your employer offers one. And then if you max out the Roth IRA, then we can still put more money back into the 401k. So you have lots of different options here, but the first thing you do, if your employer offers you matching, put in the minimum amount to get the maximum match from your employer. With everything except the defined benefit plans, You are responsible for allocating your assets, determining which investments to use, how much risk you want to take, and so on. Remember my rule, the 100 minus your age is a good way to get in the ballpark. Then we can adjust that for your risk tolerance, your other investments, and any other goals that you might have. And the last thing with retirement planning, realize this is not a once and done decision. You need to constantly reallocate your funds. That's to keep you within that 100 minus your age targets that we're going to set up. And every year rebalance your account. So if we made a lot of money in stocks, let's sell some of them and transfer that money into bonds, which probably didn't do as well. So we're selling our winners and buying the losers when they're on sale. This is a risk management strategy that works very well in the long term. Well, folks, there's a short and dirty version of retirement planning. If you have questions, please feel free to use the discussion board or call in to the Zoom session, and we'll try and get you straight.